The third quarter drawing to a close this week. Joining us this morning, Adam Parker is Morgan Stanley's chief U.S. equity strategist. Adam, we had Kashkari on yesterday, and like he's cautious. When he comes on and the market's weak, I say, wow, you knew this. And then when it moves a lot and it's gone the other way, I go, God, that was a missed call. We can do the same with you. It depends on what day, right? You have been worried about a lot of things with the market, Europe, all these headwinds and valuations. But we're just talking off camera. If the Fed's going to give a $40 billion a month again in an economy that doesn't seem that bad, you can't. All bets are off. How do you even try to gauge where the stock market's going?
I think once I became a master of the market on CNBC, everything I said started to be incorrect. Actually, before that, I was perfectly fine.
If you wait long enough, then you might be correct.
Yeah.
Though. I mean, are there fundamental underpinnings to where the S&P has run, or is it based on these? I mean, you know that when the Fed acts like this, there's dislocations in other markets. Is this anything more than a dislocation?
I don't say this to you that often. That's a great question, right? I mean,
what do you? You know what?
It's just go to commercial now.
No, honestly,
if I want to, we will. Thanks, Morgan Stanley's.
No, I think in honesty, it's been more about policy and positioning than it has been about fundamentals. I mean, if you look at most of the economic data outside of, say, housing, is the manufacturing data, jobs, industrial production, trade, balance, retail sales, they've been softer, and there's a number of big bellwether companies that have guided you down here in the last few weeks in transportation and tech. So the earnings estimates have come down. I mean, at the beginning of the year, we thought earnings would be disappointing.
Yeah.
And the two things that seem to matter for the multiple you pay for earnings are low growth. We have 0% earnings growth in the S&P in the second quarter, and the analysts think it'll be down 2% in the third. So decelerating earnings. And extreme rates. We had the most extreme 10-year ever during the quarter.
So normally, is the Fed messing up the market?
So I think what you're doing is you're creating, so far $1.7 trillion on a computer to buy your own securities to try to push people out the risk curve, and that will have long-term negative ramifications unless they can get just a perfect economic balance. It's a matter of what's timing, exactly.
Did you ever?
So we've been wrong about the timing.
Did you see some of the stuff that was written by left-wing bloggers? Did you ever think you would be a target of hate mail from the progressive wing of the?
I didn't see that. This is the first I've heard of that.
He wrote that.
It's the first I've heard of that.
Well, you remember you wrote that the market was up because it was, and the only reason you could see was that it was anticipating a Romney win.
Well, what we thought was that that investor sentiment was such that at least earlier in the year that the multiple might contract to the extent Obama won. So we weren't making a political call. I'll let you guys.
But now you said now it's going up because it's anticipating an Obama win, or
I've been surprised about that, Joe. That maybe. That maybe the multiple isn't really been impacted by the presidential election. I guess we have the debate next week, but I think it's been more about, like you said, it's been more about Fed policy.
There are those that say that the market hates uncertainty, and that we know what we got the past 4 years, and even though everyone, maybe certain players don't like the way business has been treated, but the market's done pretty well.
Yeah.
So in the market's eyes, if Obama were reelected, at least it knows what it's getting.
Yeah, I think that could be right. I mean, the volatility index is incredibly low, so nobody seems to be really worried about anything in the near term.
But then again, the market does.
But the earnings, I think the earnings are if fundamentals matter, and I believe they will again. I think the earnings.
You're arguing that you're going to be right eventually about the market being high.
I think, I hope so. And
is that a good question, or is that that's one of the questions you don't like? Yeah.
No, what keeps me up at night would be if the earnings inflect big up and I miss it. That I want to get right. But the earnings have been disappointing really since early June.
But the market and earnings are so you look at the late 90s, things were trading at 40 and 50 times earnings.
Because the belief of growth was much better. People dreamed that growth was going to be high. I don't see how with the big fiscal cliff, a base case of a recession in Europe, decelerating GDP in every major emerging market, a huge contentious election with this cliff written in the law, and record profit margins as a starting point, how you could dream things are going to explode to the upside.
If you take the cliff out of the equation,
right,
what happens?
Well, I think you could take a chunk of it out of the equation
because there's a decent chance that it does come out of the equation.
I think a big chunk of it will, and I think people believe that. I think that's in the price. But I don't know if it all will be, right? It really depends on how...
Meaning your gamble is that they kick the can and that you're dealing with this in, middle of 2013?
It could be later, right? Our call is earnings are going to be $99 for the S&P next year. The street's at $116.
Right.
So typically, as it declines, you get more afraid about that trajectory. A year ago, when the market was really selling off hard, July to September, we were getting tons of questions about what if it's a recession like 91 or 01, what would that be for earnings? Could it be $80 in earnings? This year, we've gotten 0 of those. So I don't think anybody's really bearish about corporate earnings. They now believe it'll be completely fine. So the risk is they're too complacent about that, particularly with Europe in addition to that. So.
Really, you stuck to your guns on everything else with the market, but you could have said, well, Dukakis was up by 17 points. What if the market really knows? What if the market knows that there's going to be a surprise? Or Jimmy Carter was up by 8 points going into the last week, and then Reagan had a huge win. Why don't you, you're waffling on that. You stick with all these other miscues. Why don't
what we try to do is figure out mostly what I try to figure out which sectors and industries and securities are going to do better given my parameters, right? So we try to do things
That's good.
Get out of energy.
Right, without a macro call.
Because I think this has been almost all about multiple expansion,
it's been all
not
about
the earnings.
The Fed, hasn't it?
Yeah, it has been all about policy. And so I think at some point you argue, geez, they can't keep doing this. They told you they're going to keep doing it forever.
But
more or less.
2 years ago we said they can't keep, and they did.
Right, so it kind of feels like to me, yeah, I've been wrong about that. I sort of feel like, wait, they can't do 100 QEs. They can't do 99. They can't do 98. Is the balance sheet going to be 6 trillion, 7 trillion? I mean, when are they going to stop?
Nobody really thought
QE. Never going to
stop.
Everybody was arguing against QE3, and that things would have to get much worse. And things really didn't get much worse. They just stayed the same, and they still decided to do it because of that 8% unemployment.
I wrote this a lot earlier in the year, which is I thought the economy would have to deteriorate to get more QE, and the market would go down on that deterioration before we got
Nothing
it.
happened.
So that Fed put was just at a higher price than I thought.
Helicopter Ben, that was always the name, and he's a student of the Depression, and he wants to make sure that we don't get in a deflationary spiral. Maybe we should have known this.
Look, so we did some analysis last week looking at the week-over-week change in the Fed balance sheet and the S&P change.
Yeah. And
it's correlated. And when they create money on a computer and buy MBS, it's good for the market. The work showed that what they've announced should be kind of a 3 to 4% tailwind between now and year end. So you have to ask yourself, is that enough to be offset by poor fundamentals or poor economic news? Probably not. So they're going to do more. I suspect they're going to do more and just keep going. And then I guess if you go down your logical path, then perhaps you have Yellen or somebody who even more dovish come in, and so it could just be, what do you say, helicopter? It could be raining cash at that point or whatever. So I think you have to argue, is that always going to work? Will it help the real economy? Will it help jobs? Or will it ultimately make people worried about the deficit/debt and how interest rates will be impacted in the future? We're in that latter camp. We think ultimately you're not going to pay a lot for these corporate earnings knowing they're propped up by unsustainable trends.
All right, Adam, thank you.
Good to see you guys.
All right, Mr. Master. Market master.
He is. I mean, it's like, I hope it's not like the Sports Illustrated cover curse.
I think it is. I think it's the SI curse.
I know.
I think it's the SI curse.
Trying to give it back. Adam, thank you.
Exactly. I try to bounce it right back to you.